Okay, let's get started. Good morning. How's everybody? It's the aftershock of midterm. I know. Okay, I haven't graded all midterms yet, so the results will be out hopefully by the end of this week. And then next week, we'll find time to go over them. Okay, short problems, I'll give all the partial credits I can. I'm not sure if you noticed it, the total points is 104. Okay, so I'll see how you guys go and we'll go over them next week. So today we'll continue chapter 10. Last week we started off on the first section, account for current liabilities. Now it has been for a while, so I want to kind of briefly go over what we went over. The 6 categories of current liabilities. So remember, these are the liabilities that are due within a year. Okay, so some of the categories, we talked about this in the first 4 chapters, and the red highlighted ones are the new categories introduced in this chapter. So the first one we went over last week, accounts payable. These are the liabilities, cash payments that are due within a few weeks and at most a month. So if we purchase supplies, if we purchase inventories, and we agree on purchasing these items on account, meaning we'll be paying back supplier, paying back the seller the money within a month. And if we do receive purchase discounts, if we pay earlier within the discount period, we can take off some of the cash payments amounts, and this is considered purchase discounts under inventory. All right, so this was the first category of current liabilities. This is the most liquid one. It turns into cash payment immediately 2 weeks or within a month, very quickly, compared to other types of current liabilities. And the second category we talked about was short-term notes payable. So these are still liabilities, debts that are due within 1 year, but usually it's longer than a month, a couple of months. The short-term notes is more official than accounts payable in the sense that we sign off on a note's promissory note. So remember, that has the due date, has the maturity date, the balance of the note, and also the 2 parties and interest rate involved. Right? So we're not just paying off the principal amount, but also with certain percentages of interest together when a note is due. So the first entry here, assuming that we purchased $700 worth of inventory, and we sign up on a note, short-term notes, due within a year. This is the first entry here. At the end of this year, we want to accrue and calculate what is the accumulated interest involved regarding this note, this short-term note. The reason why we're journalizing this and not directly paying by cash is because the note is not due yet. So this is the interest accrued at year end. Then when it comes to next year, after a whole year when the note is due, when it's the maturity date of the note, we're paying back cash regarding to the principal amount plus the interest, the full amount here. Okay, so this entry only occurs when a note carries on to a second accounting period. At the year end, we want to journalize the interest accumulated on this note. Then when we pay it back, we're paying back the principal amount, the interest payable, which relates to the entry that we journalized last year end. And then interest expense relates to from January 1st all the way to May. Interest expense for 5 months. But the other 7 months of interest we already accrued last year end. It's interest payable. Okay, so all the liabilities that relates to short-term notes, long-term notes, you have to take a look at a problem and see whether this note carries on to a second accounting period. Because if it does, at this year end, we need to adjust the interest. So one of the adjusting entries, accrued liabilities. Interest expense is one of them. Salary expense we mentioned in chapter 3. Those are also accrued liabilities. Okay, so every note, how do you incept the note, how you create the note in the beginning by purchasing asset, borrowing money. This is the first entry you have to know. Second is how to accrue interest. Third is when it comes to payment. How do you pay off the money? What part is interest, what part is principal amount? Okay, the third category is sales tax payable. So remember, in chapter 5 and 6, we talked about purchases entry. We talked about sales on inventory. So in those chapters, we omitted sales tax at that time. But in reality, when we make sales to customers, as long as those are sales taxable items, and we have to apply a certain percentages of tax to it, collect the sales tax by cash from customers, temporarily withholding it. Excuse me. And then later on, we have to pay it back to state government. Okay, so the first entry here, is illustrating an example on sales tax. We're making sales to customer, the retail price of a product worth $10,000. But here we're not just collecting $10,000 of cash, but also a percentage of the sales tax applied to that product we're selling to customer. However, this is not the cash belongs to our company. This is the cash that we later on need to pay back to state government. Okay, so the first entry here, we're just collecting the money, retail price of the product, plus 6% of sales tax applied to the product, all together from customer. So this entry happened last year end. And typically in a certain intervals, typically a weekly basis, or perhaps 2 weeks. Different companies have different policies. But generally speaking, all the tax payments would occur within a month. Okay, so later on, when it comes to January 20th, we're paying back the sales tax we withheld for the state temporarily, paying it all together back to the state government. Okay, so this is a liability not owed to customer, not owed to employee, but owed to state government. Okay, this is the tax applied to the product we're selling to customer. Now another category, current portion of long-term notes. So long-term notes payable, as opposed to short-term notes, it has a longer lifetime. It's more than a year. Now some cases, long-term notes could be paid off by installments. Okay, so meaning that we may not, if we borrow $20,000 from the bank, from financial institutions, we may not be paying off altogether the $20,000 plus interest 5 years later, but rather we may be paying off a portion of it every single year. So this is a case that the portion that is due within a year is considered current portion of this long-term note that becomes a short-term liability for this accounting period. Meaning that altogether, this $20,000 originally, when we sign off this promissory note, it's a long-term notes payable. But because we agreed to pay by installments, every single year a portion of it is due, plus the interest. Next year, same portion, and the interest. So every single year we pay an equal amount until 5 years, the last year we pay off the full amount. Okay, so this year ends, $5,000 of this long-term notes. Within this $20,000, $5,000 of it is due this year. We reclassify it into short-term notes payable. Okay, so this is the category of short-term notes we call a current portion of long-term notes payable. The $5,000 is due a year later. It's considered current for this accounting period. But the remaining $15,000 is still long-term notes. Okay, so the first entry here, we create the notes, signing off long-term notes. Second entry, we classify the part that is due within the year into a short-term liability account. So today in Chapter 11, we'll be covering the first section. We'll continue this example, talk about afterwards, when it comes to this year end. What do we do with this $5,000? And how do we apply interest to it? Okay, so we'll be continuing this example in Chapter 11, the first section. Now the fifth category, accrued liabilities, we talked about this concept earlier on interest. Is actually one portion of short-term notes payable, but specifically this interest relates to the idea of accruing the liabilities that is due at year end. Okay, so this is the debt that either we owe to creditor, or if it's salary expense, salary payable, we owe to employee. It's the liability that we owe to a party, but we're not paying it by the end of this year. But we still have to journalize it at this accounting period when it comes to generating statements. Okay, so this is already an expense that happened, relates to this period of time, relates to a note, or relates to employees who work for us in our company. So by the year end, if it's a note, we need to calculate from the beginning when we sign off the note all the way to year end, how many months it has been. Then apply the interest rate, apply the time period. Okay, so accrued liabilities, accumulated debts that we owe to another party by year end, but we're not paying it off by cash yet. Okay, accumulated debts. The last category you should be familiar with it by now. So this is unearned revenues, cash collection in advance from customers, from clients. So in the beginning, we collected cash, we generated this unearned either service revenue or sales revenue category. So this is a liability owed to customer. Later on, when we perform part of the service, provided part of the goods, we reverse this account bring it into actual service revenue or sales revenue. Okay, so this unearned service revenue account typically is a current liability as well. We usually turn it into service revenue, sales revenue on a monthly basis. Okay. Accrued liabilities. Okay, so these are the short-term liability categories that we went over last week. Starting off from accounts payable, we have sales tax applied to the sales to the products that we sold to customer. We also have current portion of long-term notes, the part of the long-term note that is due within this year. We have unearned revenue. Cash collection in advance later on turns into sales revenue and service revenue. We also have accrued liabilities on either interest or salary expenses. Those are the two most common examples that you will see in this chapter. Okay, so these are all the liabilities that we accurately actually know the amounts based on source documents, based on the notes, based on sales receipts. We know the product's value. Based on cash collection from customer, we already collected the cash, so we know the category, we know the actual amount of liability. Now, some of the liabilities we have to do estimation. Okay, so the first section of Chapter 10 was talking about the liabilities that we actually know the amount based on the source documents we have. Other types of liabilities we may need to do estimation on it. So this typically relates to some of the events that happens in the business, for example, lawsuits. For example, if your company co-signs a notes payable with another company. So you may have contingent liability in your business by year end. So what contingent means is potential liability. They're not actual liability yet, but they may occur, they may not occur. Depends. Yes. So we're going to talk about this. There are three layers of contingent liabilities. Some of the contingent liabilities we may not be able to calculate it at all. Right? Some of the lawsuits, if it's still in the process, we can consult with lawyers on possible outcomes, but that's not actual yet. Right? So for these possible liabilities, contingent liabilities may happen, may not. May actually turn into actual liability next period, or it may just disappear. It may not even happen or be recorded in the business. For this period, before we give out financial statements, these business events that doesn't have an actual transaction yet, accountants, they have to involve, of course this involves judgments. They also have to consult with lawyers on segregating these events into either remote possibility of liability, reasonably possible liability, or very likely probable liability. Okay, so these three layers, giving you some of the examples. If it's a remote liability, it's basically the company does not have to record anything or disclose anything on the statements. So for example, if your company is involved in a lawsuit, very trivial lawsuit, they're sued by another company, another client on some of the situations or facts they claim it's a fact, but it didn't really happen. For example, it relates to sales of the products or inappropriate advertisements, which in the case that you consult with your lawyer, it's not the case and we do have enough evidence. It's very likely that we'll win the case or not be losing the case. So these trivial lawsuits that wouldn't really affect our company later on, we're pretty confident about this, that we don't have to disclose anything or record any transactions. These are remote liability, remote contingent liabilities. Other cases, if going back to lawsuits again, these are the cases that, for example, infringement of copyrights, patents, trademarks, or we have inappropriate advertisement that in reality actually happened. The advertisement is already out on the commercials and our household TVs. You can actually see it. So these situations, these lawsuits, that outcome were not certain, perhaps 50-50. We may win, we may lose, we're not sure. These outcomes that are not certain, these lawsuit cases, reasonably possible contingent liabilities. Companies, they do have to disclose this information in financial statements. Okay, not its actual dollar amount, or if it's able to be estimated, also the dollar amount. But typically this information will be disclosed in the footnotes of financial statements. Okay, so meaning that it's attached to financial statements, but not really in the statements itself. Not in income statement, retained earnings, not in the numbers, but at the end attached in the footnotes, explaining what is the situation that happens in the business. Okay, so these are the second category, reasonably possible. In some cases, very likely these liability will happen next accounting period. We know it for a fact. So this section here will be illustrating an example on warranty expenses. So we'll be estimating warranty payable. Also, when the customers claim the warranty, we'll be actually turning that estimation into actual warranty expense. The warranty, later on we'll talk about this in more details. This is one of the contingent liabilities that we actually do have to journalize the records. So this relates to sales on products, and we guarantee the quality of a product for a certain period of time. So it's very likely that customers may come to claim we need to repair the items. So these warranty payable, estimated warranty payable could be evaluated and estimated potentially based on prior year's experience. So we usually base the estimations on sales. So later on we'll talk about how to journalize this transaction. So in summary, contingent liabilities, we break it into three categories. We need to consult with lawyers, consult with managers on the business events that happens if there's a potential loss later on. So if it's a remote case, we don't have to disclose anything. If it's likely this loss will actually take place, we do have to disclose and explain the situation because investors, creditors, they have the right to know. So then we explain the situation, disclose it in financial statements, footnotes. If it's a case that very likely would happen, and also the amount is able to be estimated, we have to journalize this transaction. Okay, it could be just estimated amounts, but we still have to disclose this journal entry. So the idea is very similar to allowances. Remember in Chapter 8, we estimate potential uncollectible accounts. Right? We estimate it based on prior experience. Here we also do the estimation based on previous experiences, if it's highly likely this loss will occur. Okay, let's take a look at an example. Let's say Cat & Company has a lawsuit pending for a customer claiming damages of $100,000. However, this company's attorney advises that the likelihood the customer will win is it's least likely, it's remote. So in this case, going back to the three layers, how do you think we should take care of this case? Do we need to disclose it? If it's a remote case, least likely that our company is going to lose, we don't have to do anything, right? Only when it's second layer, third layer, we have to actually either explain the situation or actually journalize the transaction on estimating the losses. Okay, but if it's a remote case, least likely it's going to happen. We don't have to do anything, take any action now. But when it comes to second accounting period, if the same case is still there, the estimated contingent liability layers goes into reasonably possible, then we do have to explain the case. Yes?
Now, first we get to put the calculation then, and then it rolls over to the next period, so we go back and calculate what we should have done.
Last year? No, because if this is a case by this year end, then that stays there for a fact for this year. Right? But next year, if it changes, if there's other things, other evidence that we didn't realize, and other claims related to the customer, then it will only be recorded in the next accounting period. Okay, we don't go back to change it. Okay. Okay, so this is contingent liability. Now let's take a look at specifically the third category, very possible, very likely to happen liabilities later on. We have to do the estimations on it. So this specifically, we talk about this case, warranty expenses. So when companies make sales to customers, they may guarantee the product has a certain quality for 90 days or for a year. Depends on different types of products. There may be different warranty periods. Right, so once the companies make sales to customer, they also have to do an estimation on the warranty payable and warranty expense. So this first journal entry here, assuming that we made sales to customer that were $50,000, and it tells you that our estimated warranty expense based on prior year's experience, is about 3% of these sales. So meaning that we may sell to customer at $50,000, we assume that later on, based on prior year's experiences, about 3% of these sales, we may need to make repairs on it. Okay, so this first journal entry is capturing that idea. We recognize warranty expense up front, just like before when we estimate uncollectibles. We journalize uncollectible expense up front before the warranty actually has been claimed by customers. So the 3% we multiply by the amount of sales. So we debit warranty expense, credit estimated warranty payable. So again, this is a contingent liability, potential liability that will happen later on, that we'll need to actually make repairments to the product, but it hasn't happened yet. Hasn't actually turned into liability yet. This is an estimated warranty payable. Okay, now we debit warranty expense, and later on, as part of these sales, let's say $800, customers claim the warranty to your company. Then we reverse this liability and reduce cash. So this relates to repairing the product. If we use up $800 on repairing the product, ship it back to customer, this is the journal entry that we have to make based on the estimation we did earlier. Reduce the estimation, actually reduce cash. Okay, so this is actually additional expenses made on the sales we made to customer based on the product. So we usually estimate the warranty payable based on percentages of sales. Okay, so this doesn't have to be 3% for all companies. So different companies may have a different percentages, just like how we estimate uncollectibles. A very similar idea. For uncollectibles, before we actually identify bad debt customers, we estimate uncollectible account expense up front, and we estimate allowances. So when we actually identify allowances, reduce allowances, assign it to accounts receivable. Here, we make sales to customers, estimate warranty expense up front. And when customers claim the warranty, we reduce this liability, and we're actually using cash to repair the item, to fix the item. So we reduce cash, reduce the estimated pool. So this is the third category of contingent liability. Potential liability that relates to the product, relates to the sales we made to customer, and we may need to repair it. So we first of all estimate the repairments, the warranty expense up front, then reduce cash when it actually happens. Okay, any questions so far? Let's take a look at an example here. So let's say Chester Corporation guarantees their mobiles for 3 years. And the company's experiences indicates that warranty costs would add up to about 4% of sales. And it gives you sales amounts of $533,000 for this year. Within this $533,000 of sales, we collected cash of this $533,000, 30% of it. The remaining, customers sign off on notes receivable. So meaning this is cash payment from customer to us later on. And the warranty payments for this year, we already spent $17,000 of cash on warranty. Okay, so based on this information, try to spend about 1 to 2 minutes. See if you can first of all journalize sales. So this relates to Chapter 5. Then how do we estimate warranty expense? And then when warranty actually happens, customer claims it, how do we reverse that entry, paying it by cash? Okay, how do we journalize sales? What do we debit and credit? Debit cash, what else? Sales revenue, and also notes receivable, right? Because we're not collecting all of them by cash or all of them by notes receivable, but 30% by cash, 70% by notes receivable. So the first entry here, sales on snowmobiles. And since it doesn't give us the inventory costs, so regularly sales, we have two entries, right? Here we're just omitting the inventory part. We're just recording sales revenue, and we're collecting part of it by cash, part of it by notes receivables. So you multiply 30% by sales amount, multiply 70% by sales amount. Now, how do we calculate estimated warranty payable? We have sales 533,000, right? We have a warranty based on prior year's experiences. We have the 4% of warranty expense that very likely will occur based on this sales amount. So we multiply 4% by $533,000 of sales, debit warranty expense, credit estimated warranty payable. Warranty, now we're calculating it. So based on sales, 533,000, and multiply 4% is the percentages assigned to. So based on prior years, we estimate that about 4% of these sales, we have to spend repairman expense on it. And the 17,000 is the third entry. Okay, we'll be going over that in a minute. Okay, so estimations is based on the total sales amount, multiply the percentages given to you in the problems. So for the problems you see in this chapter, you'll be given sales amount definitely, and also the percentages to help you calculate this warranty expense. So we're just estimating this part of repairman cost up front. By debiting warranty expense, crediting estimated warranty payable. Again, this is a contingent liability, possible expenses that will occur, possible cash payments on repairman that will occur later. So then later on when the problem tells you that we actually spent $17,000 on repairing the products, the products that we sold out to customers, we used up the pool of estimated warranty payable and reduced cash. Because we're actually spending $17,000 on this. Okay, so if we go back to the concept we covered in Chapter 8, estimating uncollectibles, at that time we also had an entry on uncollectible account expense, crediting allowances. So that was a pool of estimated bad debts. Then when bad debts actually happens, we debit allowances, we credit accounts receivables. Right? We assign that allowances to specific bad debt customers, bad debt accounts. Here we're estimating based on sales of the products. Part of it, we may need to spend warranty expense on it. So customers claim that the products are defective within the warranty period. We actually have the obligation to use up the money to repair the item. So we use up the estimated pool of liability, reduce cash. Second entry when the warranty actually, when customers actually claim the warranty. Okay, so based on these two entries, what is the dollar amount left in this liability account? $4,300, you use this and subtract it from the original account, right? So we have a credit balance of liability, and we use up this pool, $17,000, part of it. So what's left in the T account, $4,320, this represents future warranty expense, potentially, that we may use this dollar amount. So later on, if another customer claims, then again, we debit or estimated warranty payable, credit cash. But then if we make another sales transaction, then we estimate another 4% based on that sales. And if customer claims, again, we debit estimated warranty payable, credit cash. Okay, so that $4,320 represents future warranty claims. Okay, so these first two sections is all you need to know for Chapter 10. First section is actually journalizing liabilities, different types. So tax payable, current portion of long-term notes. First section is current liabilities, different types of liabilities, how to journalize them. Second category, contingent liabilities. Some of the liabilities we don't actually have the actual amounts yet. It's possible losses that may occur later on. We have to do estimation on them. So specifically, you have to know what are the categories of contingent liability, and in terms of journalizing them, we only need to know warranty expense, the third category, probable contingent liability. Very likely to happen, we have to journalize them. Second category, reasonably possible. We just need to disclose them in financial statements. Some of the lawsuits companies are involved are very trivial. Very likely we will win the case. We don't have to disclose anything or report anything. And so at the end of the semester, if we have time, we'll come back to the remaining parts of Chapter 10. But today I want to continue in Chapter 11. It really links to Chapter 10, some part of it. We'll be continuing the same examples. Okay, so for the first category, first section of Chapter 11, long-term liabilities, just as opposed to short-term liabilities. These are debts that have a longer lifetime. Not within a year, not within a few months, but more than a year. So we already covered one part of it, long-term notes payable, that generally speaking, 4 to 5 years or more than that. You may be paying by installments. And today we'll be focusing on the first section, how do we journalize long-term liability, long-term notes payable, and also how do we calculate mortgages. Okay. Next week we'll cover bonds. So long-term notes payable, if we go back to that example we covered earlier, borrowing, remember, $20,000 on a long-term notes payable, and we pay by installments. Every single year we pay $5,000, and we also need to apply interest to it. So in Chapter 10, what we just covered a little bit earlier is simply asking you to reclassify that $5,000 into current portion of long-term notes. So these were the two entries that we just did in Chapter 10. Okay, the first entry was accepting the notes, creating the long-term notes payable journal entry. Second, reclassify the part that belongs to this accounting period into current portion. So what happens when it comes to December 31st? When it comes to December 31st, what do we need to do? This is a note, right? So there's principal amount, there's also interest. So how do we apply interest to this? What do you think? Assuming the interest is 6%, meaning a yearly interest is 6%, and we need to apply it based on its principal amount, $20,000. But do we have a full year of interest to accrue? No. We only sign off this note May 1st, right? So how many months do we have to accrue the interest? May 1st, we have June, July, August, September, October, November, December. We have 8 months of interest, right? Starting from May 1st all the way to December 31st. So remember, every note, this is a long-term note, so it's not due until 5 years later. But since we're paying by installments, meaning part of it, principal amount, $5,000, we're paying it, but also we are paying interest amount. When it comes to this year end, we also need to accrue the interest on this note, which is the 8 months of interest, applying 6% yearly interest rate, multiply 8 months over 12. Okay, so the journal entry that we're omitting here is $800. All right, assuming that you already know this from Chapter 10, okay, so based on the note that we just showed you here, we created a note, we reclassified the part that belongs to this entire year. When it comes to next year, May 1st, $5,000 is due. So by the end of this year, December 31st, the end of the accounting period, we need to estimate interest that applies to this note. So the same formula for interest as we covered in Chapter 8 Notes Receivable: principal amount, interest rate, time period. We sign off the note May 1st. When it comes to December 31st, we have 8 months of interest accrued. Principal amount is $20,000. We always use the original principal amount, not the reclassified portion, okay, because this interest rate applies to the entire principal. So $20,000 multiplied 6%, 8 over 12. This is 2013's accumulated interest, $800. But when it comes to paying off this installment after a year, remember the installments we're paying $5,000 after a year. Every year is May 1st. When it comes to May 1st, we're paying off $5,000 plus this $800 we accumulated last year, and then additional $400 from January 1st all the way to April 31st. So 4 months of interest expense that belongs to second period's interest expense. Interest payable relates to this entry last year. And then the $5,000 of the notes, the yearly installment. All together, we're paying it by cash. Okay, so previous slide we showed there was the first entry when we borrowed the money. We collected cash, sign off on a note, long-term notes payable. And since we agreed to pay by installments, every single year we journalize this entry, exactly the same entry every single year. So we're paying $5,000 of principal. We're also paying $5,000 multiplied 6% of the interest rate. Right, so the 6%, we apply 4 months to it since this note breaks to a second accounting period. So last year we just have 8 months of interest accrued. This entire year we have 4 months of interest accrued. So this interest expense breaks down to 2 categories. And we have $5,000 principal. Add them all together. This is the full year, 1 year's installment, which worth $6,200. Okay, so again for notes, the important entries is how to create the notes. So for long-term notes, if you're paying by installments, how to reclassify the notes. And then at year end, how do we journalize the accumulated interest? When it comes to payment, how do we pay by cash? How do we journalize this debit account? So we're basically reducing long-term notes payable, recording interest. Nobody had a question on where did the current portion went? Remember that we reclassified the part into current portion of long-term notes payable, $5,000, right? So why are we debiting long-term notes payable here, but not current portion? Okay, so the thing is long-term notes payable, when it's signed off to pay by installments, we only journalize this reclassification once to make things simpler. Because if later on we pay by installments, we debit current portion, that means we have to do another reclassification entry, reversing part of it into $5,000 again. And then second year, when we pay it off, we have to reclassify it again. So just to make things simpler, we just do this reclassification entry once in the beginning. Meaning if we agree to pay by installments, every year we're paying the same amount, $5,000 principal. So immediately signing off a note, we reclassify this, and that represents the yearly current portion of installments that we're paying. We're now reclassifying it every time. So because we're just journalizing this once, later on when we pay the amount, we're just directly reducing long-term notes payable. And that current portion just stays there, represents the second year's current portion. Second year end, we journalize the same entry again, and that current portion still stays there, representing the third year's current portion of long-term notes. Third year, we journalize this. When it comes to the fifth year, that's the time we reverse current portion of long-term notes and we pay by cash. So just for just to make things simpler. In accounting, the classification entry, we just do it once. Later on, when we pay off the money, we still reduce long-term notes payable. So, meaning that if we reduce current portion here, then we have to do another reclassification entry on long-term notes payable, bring 5,000 to short-term. So we want to omit that entry. We just reclassify once. Later on, we directly debit long-term notes payable for second year, third year, fourth year. So when it reaches fifth year, that's the time we lower down current portion and just directly pay off all the liabilities by cash. Okay, let's work on an exercise together just to make sure things. This slide is just showing that if we post it to T accounts, what would it look like? So the same information, we start off from the beginning part, signing off the note, $20,000. So increasing the credit side of long-term liability, right, the beginning part. At year end, when we after journalizing that transaction, when we reclassify the portion into current portion of long-term notes, we reduce long-term, increase current portion, the short-term liability accounts. Later on, when we pay off the yearly installments plus the interest payable interest expense, we reduce again long-term notes. But that current portion, as I mentioned earlier, stays there. We don't reduce it until the very last year. Okay, so meaning that after the first year of payment, we still have 2 years of long-term notes, 1 year of current portion that represents next year's, the $5,000 that is due. Okay, so this T account just shows the entries if we posted to T accounts forms, posted previously shown journal entries to T accounts. We start off from creating the note by crediting $20,000. After crediting this $20,000, we immediately reclassify the part that belongs to current portion into current portion's account, reduce the long-term notes. When it comes to after a year, when we're paying off the $5,000, we reduce another $5,000, interest payable, $800, remember this relates to this journal entry, and then what's left after the first year's payment, we still have 2 years of long-term notes payable, the third and the fourth. The second year's is current, $5,000. Okay, am I losing you all? Kind of. Okay, let's work on an example here, all right? It's January 1st, 2014. Let's say this company signed a $200,000 5-year note that has interest rate 6%. It tells you that we have an installments payment every single year of $40,000. Interest also needs to be added to it. So based on the journal entries we talked about earlier, first of all, try to just journalize creating this note and reclassifying it. And if you can, also try to calculate first note payment. How do we apply interest? Okay, I'll go over this in 2 minutes. Okay, let's take a look at this problem together. So we have a couple of journal entries to make for this problem. First of all, how did we journalize issuance of the notes, which relates to that $200,000. Then we have to reclassify current portion, which it tells you already is $40,000. Right, so issuance of the notes, we're the party borrowing the money, so we collect cash. On the other hand, sign off the note, this is a liability. Credit long-term notes payable, $200,000. Okay, so this January 1st, first journal entry on this note. And since the problem tells you that we're paying by installments, meaning again every single year we're paying $40,000 of principal for 5 years. 40 the first year end, 40 the second year end, third year end, fourth year end, fifth year. So this part here, second entry, we want to reclassify that portion into short-term notes payable. Since we consider it into a short-term liability account, we call it current portion of long-term notes payable. Okay, so then by doing this, we reduce long-term notes payable $40,000 and put it under, just removing it under another account, short-term liability account, $40,000. So if we let's take a look at this whiteboard, just on the accounts for a moment. We have long-term notes. Up to now, we haven't paid off anything. This is just creating the note and reclassifying the note. But we already separated the notes into part of it here, long-term, $160,000 is long-term, $40,000 is current. Okay, just the first date, just on the date that we issue the notes and we reclassify the notes, already we have $40,000 as current. So this is going to be paid off within 1 year. This remaining part is the remaining 2 to 5 years, right? So when it comes to first year's payment, earlier I was asking you a question on where did this current portion go? We just do this reclassification once. So meaning that this $40,000 actually represents every single year's current portion. So when it comes to first year end payment, when it comes to first year end $40,000 of payment, we're still reducing this long-term notes $40,000. So after the first year payments, we're paying off $40,000 of principal, and we apply, again, 6% of interest to it. And this is the problem that the note just falls under one accounting period. It doesn't carry to another. So we just have interest expense fully applied to the total amount of interest. We don't have interest payable because we don't have an accrued interest entry that happened last year. This was signed up in the beginning and it was due at the end of this year. So we have $200,000 principal, multiply a yearly interest rate. And the reason why we are debiting or reducing long-term notes instead of current portion, because this we want to leave this number $40,000 to represent every single year's current portion, instead of debiting current portion here and then journalize another reclassification entry. Okay, so when we create the note, issue the note, we directly reclassify $40,000. But later on, at the end of first year, at the end of second year, at the end of third year, fourth year, when we pay off the money, we debit long-term notes payable. So after this journal entry, we have $120,000 left, long-term notes, and we still have current portion, $40,000, which represents the second year's current portion. And this $120,000 will represent the third year, the fourth year, the fifth year after this journal entry. So after the first year's payment, we reduce another $40,000, and this 40 already gone to current portion. We just have $120,000 left, which represents the third year, fourth year, fifth year's long-term liability. Second year's is here, current portion. This account just stays there until this entire note is due. Then we reverse this, then we reduce this. So this only happens the fifth year when the maturity date is here. $40,000 to long-term notes payable. This is this part. Okay, so basically what you have to know is the first entry, issuance entry, how do we collect the cash? How do we journalize this? This is the simplest issuance entry. After this, when we reclassify, we're reclassified into a short-term liability account, which actually represents every year's current portion. So we don't do this reclassification entry every single year. We just do it once when we issue the notes, if we're paying it by installments. And then this will just stay there in the account until the very last year. So last year we'll be reducing current portion. But before last year, every year's yearly payment, the entry would just look like this. So this entry applies to first year end, second year end, third year end, fourth year end. Every single year it looks exactly like this. Long-term notes payable reduced $40,000, interest expense $12,000. Sure. The issuance entries. Okay, so three main entries for long-term notes: how to issue the entry, how to reclassify it into current portion. Then when it comes to payment, how do we make the payment entry? So payments, obviously we're giving away cash, reduced cash on one hand. On the other, we're paying this for liabilities, a reduced liability. Specifically, we also have to apply interest to it. So interest relates to principal amount, multiply interest rates. And this is not an entire year note. If we sign it off somewhere in the middle of the year, we have to apply a couple of months. So 6 months over 12, 8 months over 12, depends on the problem. Okay, but don't forget this part, we're not debiting current portion. Always within the long-term notes lifetime, we debit long-term notes payable. We wait until the very last year to reduce this. Okay, so this is only reclassified once. We don't do it every single year, just to make things simpler. Okay, so every time we do the payment, as long as it's not the very last year, we debit long-term notes payable. Okay, any questions on this problem or so far? These are pretty much all the entries you need to know for long-term notes payable. Okay, now if there's no question, we're going to take a look at another category of long-term liability. We call it mortgage payable. So this is similar to long-term notes in a sense that we also sign off on mortgage notes that we don't call long-term notes promissory notes. But specifically it's for mortgage, and it's similar to the sense that it's also a long-term debt which needs to be paid off on a longer time period, longer than a year. The difference is that this type of liability is backed up by assets. So meaning that if my company borrowed money to construct a building or to purchase another building already constructed, if I can't pay the money mortgage on time, on a monthly basis on time as we schedule with the financial institution or with the bank, this asset later on will no longer belong to you. The title will transfer to the other party. So this type of long-term liabilities is backed up by assets, different from long-term notes payable, and also typically it's paid off not on a yearly basis, but rather more commonly is on a monthly basis. Okay, so there will be a fixed payment. Every single month you're paying the same amount of mortgage. Paying off the same amount includes part of it paying off by interest, part of it you're paying off the principal amount. Okay, so mortgages, again, it's backed up by assets. The different part between this and long-term notes payable is that it's backed up by assets, and usually it's paid off on a monthly basis, and that monthly payment includes part of it by principal, part of it interest, but every single month the part you're paying off for principal or the part you're paying off for interest is different. So that's the part that we need to learn how to calculate, the part that we're paying off by interest or the part that we're paying off that relates to the principal amount. Okay, so let's take a look at, this is what we call the amortization schedule. This is understanding a monthly basis the mortgages. What part are we paying off that relates to principal? What part is interest? So this example here is assuming that the company is purchasing land and building, a group purchase. and using up cash signing off on 30-year mortgage payable. So typically mortgages, they require a down payment in the beginning at the time you sign the mortgage payable. So the part that we're paying by cash right now is $49,925, and what's remaining is the part that we're paying on a monthly basis, part of it, every single month. So the total amount of mortgages is $100,075. So we start off by understanding this by looking at this right corner here. This is the total mortgages that we're paying off in 30 years. And then if we borrow money from financial institutions, typically the bank, they will be calculating what is the fixed amount of payment we're paying off to them every single month. So this part may vary based on the size of mortgages and based on different companies' credit reports. Okay, but the problems you see in the chapter, they will be directly giving you the original mortgage balance, and then you'll be given the fixed amount we're paying off every month. So what you need to do really is calculate these two columns, and then journalize the amounts based on these two columns of numbers. So meaning that for this $600 of fixed payment, monthly payment, we have to figure out what part belongs to principal, what part belongs to interest. If you take a look at this schedule, every single month looks slightly different. It wouldn't be a significant difference, but slightly different based on the reducing mortgage balance we have. Okay, so first up, we have this dollar amount, we have this column, fixed amount of payment. We know every month we're paying $600. So the first month, the part that we're paying off that belongs to interest is $500.38, which we calculated it based on the beginning principal amount, multiply the interest rate given to you, 6%, and then since this is only a 1 month payment, 1/12. Okay, so meaning that this $500 is within this $600 of payment. $500 belongs to interest payment, and the remaining $99.62 belongs to the principal we're paying. So after this first month of payment, our mortgage balance is no longer $100,075, but we're reducing $99.62. So right now the new balance is $99,975, but second month we're still paying $600. So for interest calculations, we're applying again the new balance, $99,975 multiply 6%, 1/12. So you can see that the interest expense for second month slightly reduced since we have a lower mortgage balance. And this $499 subtracted from 600, we get the remaining is the principal amount that we're paying, which increased a little. Okay, so these two columns always, if you add these two numbers together, will equal $600. Every single month, the part that you're paying for interest and the part that you're paying off the principal is different. Because every month we have a different remaining mortgage balance, which is the total principal amount that we're paying. Okay, so again, we start off from the beginning mortgage balance, $100,075, and you're being told that every single month we're paying $600. So the first month of payment, if we want to journalize the entry, we definitely need to know what is the part of interest expense that we could put under T accounts, what is the part of mortgage payable that we're reducing. Okay, so the first month of interest expense, we use the original mortgage balance, the full amount, multiply 6%, 1/12, since this is a monthly payment. Okay, the formula is the same, principal amount, interest rate, time period. So once we know the interest expense worth $500.38, that means whatever is remaining after subtracting this from 600, that's the part that we're paying off that relates to the principal amount, $99.62. So that principal amount needs to be reduced in the right-hand side column, the remaining mortgage principal balance, subtracting about $100. So it's now we have remaining is $99,975, and that becomes the second month's interest base to calculate. Right? So we use $99,975 multiply 6%, 1/12, and then the remaining part is the principal amount that we're paying. So because every single month we're paying off a little bit of principal amount, so this will gradually reduce. That means your interest to to calculate your interest, your base is also reducing. So the interest payment will gradually decrease and the principal amount will gradually increase. But remember, every single month we're paying the same amount, $600. So this is very different from notes payable in the sense that notes payable, we give you the principal amount and then the interest applies on top of that. And for mortgage, when we do the calculation, you know every single month's cash payment first, then you multiply this by interest rates and whatever is left is principal amount. So this already incorporates interest and principal together. Okay, so if we look at this entire year schedule, this is not the entire mortgage schedule. It's only for 1 year. Remember, this is a 30-year note. So we have a recurring payment every single month. So this entire year, the total principal we're paying here is $1,228.91. This part really is the long-term liability part that is current. Right? This part we're actually paying it off this entire year. So it's a current liability for this accounting period. So when we create this, when we issue mortgage payable, when we borrow money to purchase properties, we also, after calculating the schedule, we also need to reclassify the part that belongs to this year's liability, which is this $1,228. So if we look at the schedule, the first entry definitely is when we sign up the note, debit land, debit building, credit mortgage payable, and cash. Down payments and the mortgages, the liability. Second entry, just like long-term notes, we reclassify the part that is due this year. Okay, so let's take a look at the entry that relates to the schedule. So the first entry here, assuming that you already know the issuance entry, collecting assets, paying off cash, and notes, mortgage payable. Second entry, we reclassify the portion that is due this entire year. Okay, so just like long-term notes payable, we reclassify $40,000. Here we reclassify the part that relates to this entire year's principal amount. Not the cash payment, just the principal amount. And then when it comes to monthly payments, remember that mortgages we pay off on a monthly basis, recurring $600. So the right-hand side, cash will always be $600, unless this is not a fixed amount, fixed rate mortgage payment. For the problems you see in this chapter, we assume that there's a fixed amount of payments. And then the debit side, we're reducing. Going back to the schedule, we have an interest expense column, we have a mortgage payable column. So the debit side, we will incur interest expense $500, and then the mortgage payable part, the principal part that we're paying is only $99.62. So meaning that based on that amortization schedule, we're allocating the cost of mortgages every single month. So the first step would always be calculate the interest expense first, and then whatever is left goes into principal amount that we're paying off. So every month we journalize this entry. The right-hand side cash will always be $600. Left-hand side account will always be these two, but the numbers are different, slightly different. Okay, so if we go back to the schedule, the second month we'll be debiting $499 of interest and principal $100. The third month we'll be debiting $499 of interest, 38 cents, $100.62 of principal. Okay, so you have to understand how to look at this amortization schedule and what is the information it's telling you. The right-hand side is the reduced principal amount of mortgage. Left-hand side will be giving to you the fixed amount of payment every month. What you need to do is calculate these two. So the interest part is always the updated mortgage balance, multiply interest rate, multiply time period, a month over 12. Whatever is left is the principal amount part that we're paying off. And after you pay off this amount, this part you definitely have to reduce that part because we already paid it off. Second year, you use the updated balance to calculate interest expense, and then what's left that you haven't paid within the $600 is the principal part. And then you reduce this balance again. Updated balance, you use it to calculate interest again. So every single month, the recurring entry is this, but the dollar amounts, these two, will change slightly. So interest part will gradually reduce, principal part will gradually increase. Okay, so for mortgage payables, again, three main entries: issuance of the mortgage. When we purchase properties, the debit side typically is assets part. Right-hand side will be mortgage payable and down payment of cash. Second entry, based on that amortization schedule, how do we reclassify the part into current portion? Remember, if you go back to the schedule, at the end we have the total amount that is due this entire year. And then the recurring entry that happens every single month is this. Down payment, $600. Debit side, we have interest expense, and also mortgage payable. We have two. The numbers will, every month will be slightly different, right? So because this number we calculate based on an updated mortgage balance. Only the first month we use the original balance. Second month will be this amount minus $99.62. Okay? Third month, we subtract another month.